What if you could make a decision today that guarantees you save over $100,000? What if that same decision could give you complete peace of mind, knowing the roof over your head is 100% yours forever? Now, what if I told you that turning down that guaranteed six-figure win might be the smartest financial move you ever make? This sounds like a paradox, right? But it's the exact dilemma millions of homeowners face every single day. Should you pay off your mortgage early, or should you take your extra cash and invest it? One path offers a guaranteed return and the comfort of being completely debt-free. The other offers the potential for greater wealth, but with risk. With today's interest rates and market conditions, the game has completely changed. Making the wrong choice for your situation could cost you a fortune or rob you of the financial freedom you're working so hard to achieve. So how do you actually choose? How do you cut through all the noise and find the right answer for you? In this video, we are going to break it down step by step. We'll demystify how your mortgage really works, run the numbers on both sides of the argument, and uncover the powerful psychological factors that spreadsheets don't show you. By the end, you will have a clear framework to make the best possible decision for your money and your life. Before we can decide what to do with our extra money, we need to understand the 30-year mortgage. Most of us sign the papers, get the keys, and start making payments. But do you know how that payment is actually divided? It's all about an amortization schedule. That's a fancy term for a brutal reality. Imagine your mortgage payment is a seesaw. On one side is principal, the money that pays down your loan. On the other side is interest, the fee you pay the bank for borrowing. When you first start your mortgage, the bank loads up the interest side. Your payments are heavily weighted towards paying them first. A huge chunk of your money isn't building equity. It's just feeding the interest monster. Let's look at a real example. Say you have a $400,000 mortgage with a 6.5% interest rate. Your monthly principal and interest payment is about $2,528. In your very first payment, guess how much goes to paying down your loan? Only about $362. The other $2,166 is pure interest. You're paying over $2,000 just for the bank to let you borrow the money for 1 month. Over the first 5 years, you will have paid over $151,000 in total payments. But your loan balance will only drop by about $26,000. You've paid over $125,000 in interest and barely made a dent. This is the critical piece. Every extra dollar you pay towards principal in those early years is a dollar that doesn't get charged interest for the next 25 or 30 years. You are fighting back against the amortization schedule. What happens when you decide to fight back? This is the path of the guaranteed win. Paying off your mortgage early is one of the only investment moves you can make that comes with a 100% certain return. What is that return? It's your interest rate. If your mortgage rate is 6%, paying it down is like earning a guaranteed, tax-free 6% on your money. You won't find a savings account or a government bond that can reliably offer that. If you just make minimum payments for 30 years, you will pay the bank a staggering $500,000 in interest. Your $400,000 house will cost you over $900,000. But what if you found an extra $500 a month to put towards your principal? It doesn't sound like a life-changing amount, but the effect is incredible. By adding just $500 to your monthly payment, you would pay off your mortgage 9 years early, and you would save over $180,000 in interest payments. That's $180,000 that stays in your pocket, not the bank's. You achieve that just by finding an extra $16 a day. So how do you do it? There are a few simple, powerful strategies. First, the bi-weekly payment plan. The idea is you pay half your mortgage payment every 2 weeks. Because there are 26 two-week periods in a year, you end up making 13 full monthly payments instead of 12. That one extra payment a year goes straight to the principal. Another strategy is to simply round up. If your payment is $2,528, round it up to $2,600 or $2,700, or even $3,000 if you can. That extra bit gets shaved right off the top of your principal balance. And finally, use windfalls. Get a bonus at work? A tax refund? Instead of letting it get absorbed into your daily spending, make a lump sum principal payment. But the case for paying off your mortgage isn't just about the math. It's about emotion. It's about psychology. Imagine the feeling the day you make that final payment, the weight lifting off your shoulders, the knowledge that no matter what happens with your job, the economy, or the stock market, you have a home. That feeling of security is priceless. Financial experts call this peace of mind. It's freedom from the single largest debt most people will ever have. It reduces stress. It improves mental health. It gives you a sense of accomplishment and control. You can't put a dollar value on sleeping soundly at night. For many, this emotional return is more valuable than any potential market gains. That feeling of a paid-off home is powerful. A guaranteed win is tempting. So, why would anyone choose to do something else? Welcome to the other side of the argument, the case for investing. This path is built on a concept called opportunity cost. Opportunity cost is the potential gain you miss when you choose one option over another. When you use your extra $500 to pay down your 6% mortgage, you get a guaranteed 6% return, but you give up the opportunity to earn a higher return elsewhere. Historically, the stock market has been a powerful engine for wealth creation. Over the long term, the S&P 500 has returned an average of around 10% per year. Let's be clear, this return is not guaranteed. Some years it's up 20%. Some years it's down 15%. It's a roller coaster. But over decades, the trend has been powerfully upward. So let's run the numbers again. You have that same extra $500 per month. Instead of sending it to your mortgage company, you invest it in a simple low-cost S&P 500 index fund. We already know that paying an extra $500 a month on your 6.5% mortgage saves you about $180,000 in interest over 21 years. That's your benchmark. If you invest that $500 a month and get an average 10% return, after 21 years, your investment account would grow to over $420,000. By investing, you could potentially have $240,000 more than the amount you saved by paying off your mortgage. You'd still have your mortgage, but you'd also have a massive pile of assets working for you. This is the mathematical argument for investing. If your mortgage rate is low, say 3% or 4%, the argument becomes even stronger. Why lock in a guaranteed 3% return by paying down your mortgage when you could potentially earn 10% in the market? The difference over 30 years is enormous. You're using the bank's cheap money to let your own money grow in a higher returning environment. Your home equity is illiquid. Your investment portfolio is liquid and flexible for building wealth, funding retirement, or handling emergencies. Of course, this path requires a certain temperament. You have to be comfortable with risk. You have to have the discipline to keep investing, even when the market is scary. You need a long time horizon to ride out the ups and downs. If you have a low mortgage rate, a high tolerance for risk, and you're already on track with your retirement savings, the mathematical case for investing your extra cash is very compelling. So we have a guaranteed win on one side and the potential for a much bigger win on the other. How do you decide? You don't need a crystal ball. You just need a framework. Let's build one right now with 3 simple questions. First question, what does the math say for me? This is the logical starting point. You need to compare your mortgage rate to a realistic potential investment return. If your mortgage rate is high, say 7% or more, the math leans heavily towards paying it off. A guaranteed 7% return is fantastic. It's very difficult to find an investment with that level of return without taking on significant risk. If your mortgage rate is low, say 4% or less, the math points towards investing. The gap between your guaranteed return and the potential market return is just too wide to ignore. The gray area is in the middle, between 4% and 7%. Here, the decision becomes less about the numbers and more about the next 2 questions. Second question, what is my complete financial picture? Paying extra on your mortgage should not be your first financial priority. Before you even consider it, you need to have 3 things in order. First, an emergency fund. You need 3 to 6 months of living expenses saved in a high-yield savings account. This is your buffer against life's surprises. Without it, you're financially fragile. Second, you must pay off high-interest debt. We're talking about credit cards, personal loans, anything with an interest rate significantly higher than your mortgage. It makes 0 sense to pay extra on a 6% mortgage when you have a credit card charging you 25%. Third, you need to be saving for retirement. Are you contributing enough to your 401k to get the full employer match? Are you funding an IRA? Don't sacrifice your future retirement security for a paid-off house today. The tax advantages and compound growth in retirement accounts are too powerful to pass up. Only when these 3 pillars are firmly in place should you consider accelerating your mortgage payoff. Third question, who am I? What is my risk tolerance? This is the most important question. Are you the kind of person who lies awake at night worrying about debt? Does the idea of a stock market crash make you want to hide your money under the mattress? If so, the peace of mind from paying off your mortgage might be the best return you can get. The emotional and psychological benefits of being debt-free are real and incredibly valuable. If eliminating that debt will make you happier, more secure, and less stressed, then that's a perfectly valid and intelligent financial decision, regardless of what the math says. On the other hand, if you're comfortable with market fluctuations, if you see a downturn as a buying opportunity, and if you have a long-term perspective, then investing will likely feel like the more natural and powerful choice. There's no right or wrong answer here. It's about aligning your financial strategy with your personal temperament. After going through all of this, you might be thinking, I see the benefits of both. I want the peace of mind, but I also don't want to miss out on growth. And the good news is, you don't have to choose all or nothing. This isn't a binary decision. You can walk both paths at the same time. This is the hybrid approach. Take your extra $500 a month. Send $250 to your mortgage company as an extra principal payment. Invest the other $250 in your index fund. With this strategy, you are still accelerating your mortgage payoff. You'll still save tens of thousands of dollars in interest and shave years off your loan. But you are also building a liquid investment portfolio that's growing and compounding for your future. You get a taste of that guaranteed win while still participating in the potential for market growth. For many people, this balanced approach is the perfect solution. The debate between paying off your mortgage and investing isn't about finding a single universal answer. It's about finding your answer. Start with the math. Compare your interest rate to potential returns. Then, look at your whole financial life. Secure your emergency fund, kill high-interest debt, and fund your retirement. Finally, be honest with yourself about what truly matters to you. Is it the guaranteed security of a paid-off home, or the potential for greater wealth through the market? Whether you choose to pay it all off, invest it all, or find a balance in between, you are now equipped to make a conscious, informed decision. You have the framework to build a strategy that not only grows your wealth, but also brings you peace and confidence. Now I want to hear from you. What path are you on? Are you team pay it off or team invest? Or are you taking the hybrid approach? Let everyone know in the comments below. Your story could be the insight someone else needs to make their own choice. Thanks for watching. If you found this valuable, a subscription to the channel would be amazing. Until next time.